Welcome back to the channel. It is the 5th of May, 2026, and we have to talk about the absolute monster that is Palantir. If you've been following my investment diary, you know we've been waiting for this Q1 print, and honestly, it didn't just beat expectations, it shattered them. Let's dive into the diary entry for today. Palantir just posted 85% year-over-year revenue growth, hitting $1.63 billion for the quarter. That is the fastest top-line growth we have seen from them since their listing in 2020. To put that in perspective, they almost doubled their entire business in just 12 months. The numbers you need to know. This wasn't just a revenue story. The profitability is getting insane. GAAP net income hit $870.5 million, which is more than 4 times what they did in the same quarter last year. We're looking at an adjusted EPS of $0.33, clearing the consensus of $0.28 comfortably. But the metric that really has Wall Street buzzing is the Rule of 40 score. For most software companies, hitting 40 is the gold standard. Palantir just posted a 145. CEO Alex Karp actually said they have shattered the metric, putting them in a tiny elite group alongside names like Nvidia. The real engine here is the United States. U.S. revenue grew 104%, topping $1.28 billion U.S. commercial. This segment is on fire, growing 133% year-over-year to $595 million. Their customer count crossed 1,007, and they are signing marquee names like Airbus, GE Aerospace, and Stellantis. U.S. government. While people thought government growth might slow, it actually accelerated to 84% growth, hitting $687 million. They also just bagged a $300 million USDA contract to help secure American farmland and supply chains. Now, let's talk about the tech, because Karp was in rare form on the earnings call. He's doubling down on the idea of AI slop. You know, those flashy AI demos that don't actually work in a high-stakes enterprise environment. Palantir's pitch is that they provide the no-slop zone. The secret sauce is the ontology. It's the framework that allows AI agents to actually understand an organization's data and rules without causing enterprise disaster. CTO Shyam Sankar used a fascinating analogy called Jevons paradox. He said tokens are the new coal and Palantir's AIP is the train. Basically, as AI gets cheaper, companies will use more of it, but they'll need Palantir's harness to keep it from becoming a mess. Management is so confident they raised full year 2026 guidance to $7.65 billion. That's nearly a $400 million raise from their previous forecast. They are also expecting U.S. commercial revenue to grow at least 120% for the full year. The valuation reality check. Okay, time for the investment diary part of this. The tough talk. Is it still worth chasing? The valuation is, frankly, uncomfortable. PLTR trades at a forward PE near 110x. Compare that to Nvidia at 30x or CrowdStrike in the mid-70s at 110x earnings. You are pricing in near perfect execution. If growth slips for even 1 or 2 quarters, the drawdown could be meaningful. My takeaway: if Palantir is already more than 10% of your portfolio after this run, it might be time to trim back to your target weight. But if you have a 5-year plus horizon, the multi-year AI thesis looks incredibly intact. What are you guys doing? Are you holding, adding, or taking profits? Let me know in the comments. I'm staying long, but I'm watching that government growth rate like a hawk for any signs of a slowdown.